Good morning, FFG. Today we're going to talk about, in our episode of FFG TV, is how I do my annual reviews. To me, this is the second most important part of what we do, second to the policy deliveries, because this is where we continue to build the relationship with the client. I want to review their annual statements. Again, I'm going to a lot of times reiterate how indexing works, because most clients have a hard time understanding it from year to year. And again, develop the relationship, look for other business opportunities. There's a lot of benefits that come out of meeting with that client every single year. There's several things that I bring with me every time to the annual review. First of all, I bring a copy of their statement. Number two, as I bring a copy of the policy values illustration that I did when I issued the policy a year previous. I bring a copy of my illustration or annual statement, so I can show them how mine's been working after 6 years. And I bring forms that I think they may want to do, like for instance changing some of their crediting strategies, changing beneficiaries, changing bank accounts. I have all that information with me, or all the forms with me, just in case they need to make those changes. So the first thing I do when I go over their annual statement, I want to tell them just a little bit again of how indexing works. That Aviva is going to go back to the beginning of the year and compare the market value, S&P value at the beginning of the year to the S&P value at the end of the year, and that's how they come out with the interest. So the first thing I do when I look at their statement, I show them on the very front how much cash value they have at that particular time, and then I compare it to the policy value statement as far as what we thought we would have at the end of the first year. And 99% of the time on all the ones that I've done, it's within $100 of what we originally illustrated. So then I flip over to the age 60, 65 to show them the amount of income that we've projected, and again ask them if they're happy with the amount of income that we've projected at that age, and then back up and say, you know what, it's exactly where we thought it was going to be. This is the amount of cash we thought we'd have in the policy. This is how much we actually have. You are right on track to accomplish your financial goals based on the amount of money you're putting into this policy. I do that every single year. That's the first thing I do, is I compare it to year 1, year 2, year 3, year 5, all the way down, and compare to exactly what they do have on the annual statement and what we think they should have. And on the ones that I'm doing 4 or 5 years later, it's identical to what we thought we were going to have, and that's being illustrated at between 8.5% and 9% interest. Right now, the interest rate's a little bit less than that, so all the new policies that I'm doing are around 8.2 to 8.4%. But even on the older ones, the numbers are almost identical. So the second thing I do is I talk to them about surrender charges. I said, listen, this is not, if you decide to cancel a policy, this is not the fee that Aviva is going to send you a bill for, but Aviva wants you to have a certain amount of money in these policies, and anything above the surrender charge is money that you have access to between now and 59.5 with no penalties. So a good way of looking at it is that the surrender charge is a reserve amount. And because we want to focus you on the living benefits versus just the death benefits, our goal is to get you above the surrender charge so that you have access to that money for things that you need. Now, if you decide to cancel the policy, Aviva is going to keep what you've got in there, because they've spent all the money to get the policy underwritten. They've put all of the money up front, so they have 15 years that they're anticipating having the opportunity of managing this money for you, and so they're gonna, anything that you don't have up to the surrender charge, they're going to keep if you cancel the policy. Anything over the surrender charge is available to you to use throughout the life of the policy. That's the easiest way for me to explain it. I go to the second page, which talks about the money going in and all the fees being charged. This is what most people have an issue with, and it's really hard to explain unless they can sit there and look at the first statement. But this is also why it's critical to do the annual review, because sticker shock will kick in. A lot of your clients, if you're not right there when the policy comes out, they're going to not understand it. They're going to think that all their money is going into fees and expenses, and the policy doesn't work the way that you've set it up, so that you've lied to them. And if they don't have that initial interaction with you, they're calling Aviva to cancel the policy. That's why annual reviews to me are critical. So the first thing I want to explain to them is show them how much money is going in. So they're putting in $500 a month. The second column is the premium expense charge. This is the only column that changes based on the amount of money that they put in. Everything else is based on the size of the amount of life insurance and the size of the plan that you set up for them. So as they put money in based on the type of policy, whether it's a lifetime builder, advantage builder, it's usually somewhere between 3 and 5% of the amount of premium that they put in. So if they put in $500, 5% of that is $25 a month. If they put in $1,000 a month, they're going to pay $50 a month. So that's going to change every time they add or decrease the amount of premium. It's also going to go away when they start taking loans in the future at 60, 65, 70, whatever that age is, because they're no longer putting money in. So it's not a fee and an expense that's going to keep going. The second thing, and this is the one that's probably the hardest for people to understand, is the premium expense charges. And what this is a 10-year charge that Aviva charges to offset the cost, their costs in the policy, and to do the underwriting and things like that. It's also designed to keep the policy in force in the future if once you start making the payments. So again, they're holding this money back to cover the cost of the expenses of the policy from age whatever it is they took it out to age 121. And they only do this for 10 years. To offset this, though, starting in the 11th year, Aviva is going to add back into the policy 0.6% guaranteed, or on some of the older policy it was actually 0.7% guaranteed, based on the size of their account value. So they're going to pay this expense for the first 10 years, so they have the opportunity to earn an interest rate enhancement bonus from the 11th year on. So that bonus is going to get paid out for 30, 40 years, and all they've done is pay expenses for the first 10 years. So it actually, and I show them after the 20th year, they're making more back per year than what they've been charged for the first 10 years. Okay, so that's how I explain the policy expense charges. The next column is the cost of insurance. That's just based on whatever the life insurance is. If you put it on increasing death benefit, it's going to go up every year, but it's also going to be reduced by the wellness rider starting in the 3rd year. So they'll start see those reductions starting in the 3rd year. The last column is the rider expenses. I probably on every single one, as a matter of fact, I just make this a criteria for myself and my agents that we put the wellness rider on every single policy. So for the first year, you're going to see an expense of $833 a month, or $433 if it's $50 a year instead of $100. And I just tell the client that at the end of the first year, that $833 is going to go away. So the second year it's going to be zero. So that extra $8 is going to go right into their cash value. So whether they're putting in $500 a month, or $1,000 or $5,000 a month based on the policy, those 3 columns, insurance amount, rider charges, or insurance premium, rider charges, and policy expense charges do not change. They're going to stay the same. And so really the only expense that goes throughout the life of the policy is the cost of insurance, because obviously if they pass away, Aviva's on the hook for the amount of life insurance. So I explain that to them, make sure they don't have any questions with that. The third thing I do is I go through the crediting strategies. There's usually 4 different crediting strategies that I put on every policy. Number 1 is the basic interest. There's no way to get around that. Right now the basic interest is paying 4.6% on the current policies, and I think 4.25% on the older policies. So I tell people that no matter how bad the market is, you may earn zero interest in your market buckets, but in the basic interest amount, you're still going to earn 4.6% every single year. And this will fluctuate from year to year, but for right now, it's at 4.6%. Then I go through the other three. I usually use the 1 year point to point. I explain how that works again. I use the 1 year monthly cap, and I explain how that works. And I use the 2 year point to point. I explain how that works. And then the final thing I do on the policy or the annual statement is I go down and I show them exactly how much money that they have going into each one of those market buckets. And I show them, okay, so you're going to see one of three things happen. If you see, you'll see the column that says indexed earnings. You'll see a beginning value and an ending value. The ending value is the beginning value plus the indexed earnings. The indexed earning is going to have one of three things. It's going to have a zero. If it has a zero, that means the market went down for the year and you got zero interest. And if you notice, your beginning value is the same as the ending value. So there's no changes. It can have an NA, which means that you've earned interest, but it hasn't been credited yet. I was just delivering a policy or doing an annual statement on a client the other day, and their anniversary was April 30th. Well, in the May 11th column, it had NA. And I said, well, from May 11th of 2011 to May 11th of 2012, you've earned interest on this policy, but the policy was issued in April. So you haven't seen that. It hasn't been reflected. It will be reflected on your next statement. So you just got to be patient. So all these NAs, this column that has 8 different NAs on it, means that you've earned interest on those month or that year, but it just won't be reflected till the next statement. Then the last thing is you'll have a dollar amount. That dollar amount represents the percentage that the market increased for the year, and that's going to be your interest rate. And I show them, I said, so you have $100 in that particular bucket. You earned $10 of interest. That was a 10% interest rate. You have $200 in the policy and it only earned 5%. That means the market went up 5% last year. If you had $200 in that month and you earned $24, that means the market, you earned 12%, which is the cap. So the market could have either done 12% or it could have done more, and you got a cap. If you earned 0, that means the market went down for that year, but you didn't lose anything. You just got 0 interest. So I make sure they understand how each of the crediting strategies work and how it works in relationship to what they've done. So it's really critical for me that they understand exactly how this policy works and how to read the policy, so that I'm not every year when we come back, we're not going over it in detail again. They have an understanding and a concept of exactly how it works. Again, it's based on fixed interest. The fixed interest is a relation of how the market works on a year-to-year basis. So once that interest is credited, it gets locked in, and that now becomes your new account value. The other thing I want to show them is I pull the 10-year averages of the 10-year values of the S&P, and I go back and I show them what the S&P did over the last 10 years and show them how to track the amount of interest that they earn on a monthly basis, so that they can track it themselves. So they have a good idea of exactly how much they're going to earn from month to month based on how the S&P performs. So again, my main premise with them is to help them understand this is a long-term strategy that is working exactly the way that we had set it up for them, and that the only thing that we might want to change for this year is the crediting strategies. Based upon how Aviva structures their caps for the year, different strategies are going to be providing different opportunities. So some years maybe I'll put them into a multiple index strategy. Some years I'll put them into monthly cap strategies. I usually will always do the 1 year point to point and the 2 year point to point, because historically those are the ones that give us the best interest rate, and they're also the ones that are the easiest to understand. I had a conversation with Mickey 4 or 5 years ago when I first got or first signed on with FFG, so probably about 6 years ago. And his feeling is that no matter what strategy you pick, they're all going to, in the long run, equal out within a half a percentage of each other. So to drive yourself crazy trying to fix and maximize the strategy really doesn't matter. But sometimes a client wants to maximize their interest for the year, so I'll make sure that I put them in the strategy that will help them maximize that. I also want to make sure that all their information is the same, that if they've gotten divorced, married, that we're addressing that. We're changing beneficiaries on them. If they've got married, we need to make a name change. If they've changed address, we update the addresses. One of the big things for me is if you have a client that was rated a year ago, whether it's for weight or for health issues, if they've had a drastic improvement in their health, clients that were smokers at one time, they're no longer smokers a year later, I'm making sure that we're getting their policies reissued at the non-tobacco rating versus the tobacco, because that's going to save them hundreds of dollars, thousands of dollars over the lifetime of the policy. For clients that do smoke, I illustrate how much it would cost or how much it would benefit from them if they quit smoking, and I just show them that as an alternative. Say, look, if you ever do decide to quit smoking, you have to have quit for a year. Now we're able to change this to a non-smoker. Look how much money. I actually had a client, after they saw that it was going to cost them or increase their income by about $12,000 a year, quit the next day, called me and said, hey, I'm a non-smoker now. When can we go ahead and get this looked at for those ratings? I said, well, you gotta have quit for a year, so when we get back together on our next anniversary, if you still haven't smoked in a year, we can do that. Well, a year later, hadn't smoked. We reissued it as a non-smoker. He keeps the premiums the same, but his cost of insurance is cut in half. So again, it gives him about $12,000 more in income when he gets ready to retire. So again, it's really our responsibility as their advisors to make sure that we're making these changes. And I know that sometimes annual reviews are not the easiest thing to do, because it does take a lot of time and energy out of our daily activity as far as meeting new clients. But my philosophy is this, that when I got these clients into this policy, I made a commitment to them. I made a commitment to them that this would work, that I would be there to help and make sure that it works for them based on the amount of money that they put away. And the only way that I know how to do that is to meet with them on a regular basis. So out of a commitment to them, a commitment to myself and to my career, it's the right thing to do. That's why I'll take an hour a year with these clients and go through this with them. Now, out of all the clients that I have, probably 600-700 clients, I probably see 50 to 100 of them every year. Some of them will meet with me more often. Some of them will meet with me less frequently, maybe once every 2 or 3 years. And some I never meet with. They get newsletters from me. They get constant contact and emails from me. They know that I'm available. And then I just let them tell me and dictate to me when the right time is to get together. I've got some clients I haven't met in 6 years, but I communicate that with them by email and phone all the time. No, I'm fine. Don't need to meet with you. I'll call you if I do. The other thing that I do on annual reviews is I really make sure that I'm addressing some of these other concerns, like children policies, spousal policies. If we haven't done this at the beginning of the year, at the start when we get everything started, maybe they've had a change of careers, made some more money, have more money to put away for their kids or for their spouse. I'm always looking at opportunities to turn this into a sales opportunity with the client, because obviously the happiest clients are your best clients. Also, the best way of turning that into to new business. I'm asking again for referrals. I had a great example the other day. I was doing that's probably about 6 months ago. I was doing an annual review with a client, and I said when we were all done, she goes, "Man, this is great. I love this. I really want to thank you for for all your help and everything that you do. And I asked her, I said, how would you rate me as your advisor? Would you give me an A or would you give me a D or an F? She goes, oh, I'd give you an A. She says, you contact me all the time. You're always there to help me make changes and make sure I understand this. So I'd say you're an A as an advisor. I said, well, you know what? I have some bad news for you. I'd say you're probably a D as a client. And it took her back a little bit. And she says, what do you mean I'm a D as a client? I said, you know what? I've been working with you for 3 years now, and you have not once sent anybody my way that I might be able to help. I know you have tons of friends and tons of people that are in your age group, which was 32, that would be perfect candidates, and they really need to look at some options to help them protect their money. And I haven't gotten one referral from you in 3 years. A week later, she sent me an email with 2 referrals. So, sometimes you have to kind of put it on the line with your clients and tell them what you expect and say, look, I really make it a practice and part of my practice to help clients solve some of their income and retirement needs and their frustration about the stock market, frustrations about how their IRAs and their 401ks work. My best clients come from the clients that my clients refer me to, people my clients refer me to. So if you're not referring people to me, how can I help the people that are the most important to you? And so she sent me an email with 2 people that I actually sat down with and I put a plan together for one, and we're still working on the other one. So I know that it's a lot of time. I know that it can kind of be a pain sometime to do the annual reviews, but I think it's critical. It's part of what we do. And if you go in there with the right attitude, if you go in there with the attitude that not only are you going to solidify the relationship, that you're going to help your client to once again understand why they set this policy up, how it's working, that it's working exactly the way that you committed to them that it was working, and then you ask them for the other business, it's a perfect time for you to get that from them. And whether it's business in their house or people that they know, it's a lot more relaxed, so you can take the time to explore different possibilities with them. Ask them what's changed in their life. I always will have a copy of the original F&A with me, so I can go through things. If they're getting a car that's almost getting ready to pay off, if they've got kids that are graduating from school, I'm always looking for other opportunities to free up some money so that I can have a conversation with them about putting in more money into these policies. My goal with clients is to get them to fund as close to the maximum MEC limit as they possibly can, because I know, and I've seen this happen in my own policy, that the closer they can get to that MEC limit, the more they'll have and the sooner they'll have access to it. One of the other things that I do, and for those of you that are very new, you won't be able to do this initially, but I've had a policy with Aviva for 6 years. I will pull out my policy again to show my clients that this is exactly what I do. That's not theory to me, that I'm using the same crediting strategies that I have them in, and also to give them a glimpse into what their policies are going to look like 6 years into the future. How the interest rate gets credited, how much interest they're going to earn, how after about 5 or 6 years, the amount of interest that they earn is going to offset the cost of the life insurance and the fees, expenses, everything else, and they're going to be in a positive situation. To show them how the loans work, to show them how easy it is to take loans out if they need a loan for whatever they need it for. I want them to understand that I know what I'm talking about because I'm doing the exact same thing, and we're in this boat together. I have a lot of choices. I have a lot of opportunities that come across my desk all the time as far as investments and what I could be doing with my money. And based on all those different opportunities, I still choose this Aviva product because I like the fact I can sleep at night because I don't have to worry about losing my money in the market. I don't have to worry about what tax rates are going to be 20 years from now. I don't have to worry about not being able to fund it the way that I want to fund it. I don't want to worry about, if I need to take money out, it's going to take me 6 months and a bunch of paperwork to take money out. I get a check within 5 to 7 days from Aviva. I want to eliminate all those things from my future because I know that at some point 65 or 70 is going to come. I'm going to want to retire, and I wanted to be in the vehicle that's going to give me the most retirement income of anything that's out there. That right there, whether it's on an initial sale or whether it's an annual review, I promise you guys, has done more for my career than anything else. And so if you guys, especially ones that have been in for a while, if you don't have your own policy, that'd be the first thing I would do, because it's instant credibility, and it'll save more cases, and it'll make more money for you than anything else by just having your own policy. And if you can't afford it, figure out a way to afford it. And if you can't qualify for it due to health reasons, then do it on your kids, do it on your spouse, do it on somebody that you have a relationship with, so that you have the same product that you're offering to your clients. I promise you guys, if you do this and do this the way that I do it, or close to it, that you'll have successful annual reviews. Your clients will love you. They'll understand this product. Some of them will take 4 or 5 years maybe to understand it. Some of them will do it a lot quicker than that. The more and the sooner that you can help them understand it, though, the more people that they'll refer to you, and the easier it will be in the future when you do the reviews. I've got clients now, when I call them up for an annual review, no, I understand it, I'm just being patient, I just put it in the drawer, I don't even think about it. So I would say probably the two most critical times to do their annual reviews is the first 2 years. Help them to understand at the end of the first year that it doesn't look that exciting, but all the value is going to happen starting in the second year, and then get together with them at the end of the second year and show them after 2 years how they're starting to earn interest in their policies. You do this, I promise you guys, it will be a very successful annual review for you, and you'll be amazed at how much money you'll be able to get out of your clients in the future, either on them or people that they know that want to sit down and talk to you. If you have any questions, give me a call. Other than that, create a great day. I look forward to seeing you guys soon. Bye now.